quick video. I've gotten a lot of requests and questions in reference to a few items pertaining to capital structure, funding, how to move forward, what our plan is. And we're going to be releasing a video series on the capital markets because I'm eager to educate everyone. I think there, from the phone calls that I've had personally with some of the shareholders and/or investors, and as well as some of the questions coming in through social media. I think it's a good idea to get everyone on the same page, give them accurate information, something they're not getting, third hand through some chat room or blog, by someone who may not be as educated or feels they have an understanding when they truly don't have a full grasp of the material and/or fundamentals. So this video can be viewed as a prelude to that video series. There's a few things I want to address. We've gotten a lot of feedback. We have a very active shareholder base, which is just great, and it lets me know not only where we are as far as how we're doing for the shareholders, but where the shareholders are and where some of their questions may be, as well as what questions they might be afraid to ask. A lot of people don't want to ask questions for fear of feeling ignorant or stupid or something like that. That's never going to be the case when you call and speak with me or anyone on my team. It better not be. So we want to make sure that we answer those questions. Now, I can't give financial advice, so I'm precluded from doing that as well as everyone on the team. But what I can do is make sure that all of our definitions are the same and our fundamental understandings of strategic actions and/or filings are clear and it's shared. Okay, so the first thing is we've got a lot of questions on funding, how we're going to achieve that, how we're going to move forward, and some of the things were debt structure. I feel it's going to be very beneficial once the Q2 filings go out that we can maybe walk through those filings and everyone understand what those filings actually meant. So, and I will kind of break away here for 1 second. So we put out the video on Friday, the update video, and probably within an hour, I had received a couple of emails, social media had received a couple of questions pertaining to when the Q2 filings are going out, what do they look like, etc. Those questions were answered in the video. So what I want to really emphasize here, these videos are only useful if you use them. They only work and they're not a value add unless you view them. I know sometimes they're lengthy. Believe me, I have to watch these videos to make sure that everything is accurate, and I don't want to watch me for 20 minutes. I got other things I could be doing, right? So I understand that. I empathize, but I do put these out because I genuinely want to make sure that our shareholders are caught up and that we're addressing every concern or question that we possibly can, whether it's something timely or whether we're even allowed to do that. So I try to respond to everyone, as many of you already know. So don't want to beat a dead horse. So debt capital. So how is it that a company can raise money? There's really two ways. There's debt capital, equity capital. Debt capital is when we take a loan on. That's a good example, right? So if we borrow money, then we have to pay that back, and that's one way to raise money to expand, continue our operations. There are a couple of downsides with that. Obviously, now we have a debt, and we owe, and we've created a debt piece that there are ways to address, and I'm going to get into that, but they have to be taken on in an intelligent way by management that understands the long term. So if you have a management team that's just thinking about the next 30 days, that's a disaster or a recipe for disaster, in my opinion. Let me just say that, in my opinion. So when we look at debt, we look more of a long-term piece, 5 years and beyond, and try to figure out how is that debt going to fit into our growth. So for every dollar we get in, what is going to be the return on that expenditure for us? There's a cost. Money's, in many cases, especially in OTC arena, these loans are very high interest, which is one of the reasons we don't. When you look at our financials, you'll see that we haven't taken on many of those, especially institutionally or by groups that are trying to capitalize on that space. I'll put it that way. So you're borrowing at an interest rate. Many times those structures, and I've looked at many of these over the years, are going to have a compounded interest rate because they're going to go beyond the initial term. They know that. The people lending the money, they know that. And they capitalize on it, especially on the microcap companies, on the pink sheets. This is an inherent problem with being able to repay the note, right? So that's another way they do that. And so what is the bottom line on that? You have to repay it. It's a debt, right? Equity capital. Equity capital is going to be the company raises money through the sale of its equity in the equity in its company or shares. Now, there's a couple ways to do this. You could do that through common shares. You can do that through preferred series shares. For us, the preference is preferred series. Why is that? And I'll tell you my particular strategy on that. When we issue loans with preferred series, there's a component of it that we have control. We are trying to protect the liquidity of the market in which we trade under our ticker symbol, but we are also trying to protect the price per share, right? So we don't want a bunch of stock just hitting the market. So with non-reporting companies, the legend or the restriction, as many people in the industry refer to it, we really internally say the legend is usually 12 months. Fully reporting is 6 months. So there's a 6-month restriction. So then they can convert to free trading shares and then they can sell into the market. With us, we issue preferred series. We have a block. Typically, it's going to be preferred B, and that is going to be specifically used in our case for capital raises. That's why we've allocated what we've allocated. I'm not a big fan of issuing common shares. Why is that? So on preferred series, I have to be notified by the transfer agent that they intend to convert from preferred to common, and then I can either authorize that or not authorize that. And then what I would do in that situation, say you have 100,000 shares, they're going to convert out in preferred series to be 1 to 20. So now you're looking at a large block of stock that would hit the market. So what I go back and say is per our agreement, which any agreement we've ever done, I will authorize the conversion of 10% of your holdings in preferred series, provided it does not exceed 10% of our current liquidity, market liquidity. So I put a lot of restrictions internally to protect that. And these are some of the fail safes that we've used. And these are some of the tools that many companies have and utilize. So the equity is a more powerful piece for us, gives us a little more control, and we don't have to repay the money, right? So the money comes in, it's allocated, and now we're not as time crunched or pressured to make sure that invested capital turns around a return so that we can pay or service that debt. So these are some of the tools that you can use for capitalizing. Now, the reason I'm bringing this up is I want to make sure everybody understands there's really only 2 ways to do this. I know people are going to sharpshoot me on this, but if you watch the whole video, you understand. Yes, people can say, oh, that's not true. You could do an IPO and you can do a Reg A and S1. I understand. We're going to get to that. But those mechanisms, those tools, or those corporate actions really boil down to 2 ways, and that is going to be debt and equity. All right, that's why I want to make sure they understand, because it's going to be important when we review our filings and our financials for everyone to understand that, okay? So this is a prelude to what we're going to be doing on the video series. So I want to make sure we're speaking the same language. So let's go into Reg A. For some reason, this must be going around on the boards. I'm getting Reg A's and reverse splits almost on a daily basis. So let's talk about these things so that we understand why these tools can be either useful or not useful. They can be good or detrimental, right? Many that are watching this video know how I feel about a few of these things. But let's just get some clarity and let's get a common understanding or shared understanding. So what is a Reg A? A Reg A is similar to an S1 or an IPO. It's a registration statement. It gives you, it's essentially an exemption, if you will, from certain SEC requirements, registration requirements, right? So there are a couple ways in how to file a Reg A. There's Tier 1, Tier 2, Reg A Plus, a lot of them refer to it. In March, they just changed the laws. So on a Tier 1, it's up to 20 million you can raise in 1 year time span. And then there's Tier 2, which is 50 million Reg A Plus, kind of, I won't say circumvents, but doesn't have a blue sky requirement, you will. Let's go into that a little bit. I know this may seem to be a little bit. So I have some bullet points here I want to make sure that we hit because it's important that I give you at least some data that you can go research this on your own if you really want to delve into this. We can go deeper, do a deeper dive on this if this is something that everyone is interested in. But I want to make sure that we understand the basics. So on a tier 1 Reg A, like I said, you can raise up to 20 million in a 1-year time frame. How does this differ from a tier 2? On a tier 1, there's no continual reporting. You report a final report and that's it. And that's the big difference other than the dollar amount size that you can raise. Okay. So I'm just going to give you the basics. We're not going to get into all the nuance and some of the things that can be beneficial for each particular tier. Now, on a tier 1, you have to register with every state you're going to offer in. So in the United States, you have to register with 50 states, which equates to really 54 different sets of laws. How do I get to 54? 50 states and 4 territories. Okay, so if we want to offer across the United States and its territories, we have to meet requirements for all of those areas that we are offering the security in. This was where that blue sky comes into play, and that is very cumbersome and very lengthy. And then you're dealing with local regulators that are going to give comments back. So it's not just the SEC you're getting comments from. Now you're getting it from each state. So it's a very long process. So on tier 2, you don't have that. And now, since March, you can go up to 75 million. So tier 2, 75 million. And these are important for a reason. You don't have to go through each state, like I said. You also, and again, I understand that we're saying that there's limited, some exemption in some of the registration, but you do have continual reporting to do in tier 2. I favor this. I think it's much more important to constantly communicate with everyone, including the regulators, so that everyone understands where we are each step of the way. The last thing I think anyone would want, in my case, it's an accurate statement. I don't know about other CEOs, but I will say that I think it's much better to have constant communication than to pop up a year later and say, here's my paperwork, if you have any questions. That's not going to go well, in my opinion. I've been dealing with regulators a very long time. I think that's but that's the way it's done. The main thing here on a Reg A is that it's a faster, cheaper way for crowdfunding, essentially. I'm oversimplifying, but I want to make sure everyone understands that what we're really doing here on a Reg A. Now, a Reg A is something that we've taken a look at. I'm going to go over a few examples or a few notes as to why it's a good thing and can be a bad thing. Reg A plus. So a Reg A plus would be stated as a Reg A plus tier 1, tier 2. It depends on what the company is looking to achieve. These shares can be turned around and sold right away, unless you're looking at preferred series that's non-CUSIPed. And then again, we're back to that default mechanism that I've put in place for the company. For me, I'm much more interested when we're looking at issuing blocks of stock or taking in larger blocks of capital to have long-term shareholders, long-term investors that understand what the goal is. That the goal is not over the next month or two. The goal really is 5-10-year plan. Where are we going to be? How long does someone want to stay on board based off of what we've identified and outlined what the plan is? So for me, that's much more appealing. Again, on an A plus, you would not have those blue sky laws because if you're in a tier 2, tier 1, you would. Okay, so I want to add one thing to this. The company has to register and allow for the sale. So if there's no market, then there's no exit for that investor. I think it's best to have these conversations up front with investment banks or institutional financiers, because it leaves less room for miscommunication or a misunderstanding later down the road. And I like to have everything in writing. So that's how we do it. So we have looked at uh, looking at a Reg A as opposed to going right into the S1. We are currently reviewing some options. So why is it good? Why is it bad? It'll give you some bridge financing, some midterm financing, uh, or capital, I should say, to allow the company to continue through a growth phase or even start a growth phase in some cases. It's essentially a mini, they refer to as a mini IPO. So they're very similar. It's not exactly like an IPO. There's some nuance there, but it's something that can be good. Now, here's the downside. If you do a Reg A with a group of, a small group, they like to do it in blocks. The problem with that is they're going to sell stock into the market. To me, that's not good. Now you're dealing with dilution. You're dealing with affecting the liquidity and price per share, the value of the not just the price per share of the market and the market cap. That's not a good strategy. It's very short-sighted. So for us, when we look at that, you have to have the right relationships in place. We do have in the past, we've done some things with a particular group, and they were very interactive, very cooperative, highly communicative. So, this is something that is important to me. I need to know what's going on across the board, whether it's internal to the company or outside the company. So that's why we haven't done a Reg A up until now. Up to this point, we have not considered a Reg A. I've been offered it many times, but I've been doing this long enough to know that this could be a problem. Now, for us, we do have a relationship where we are exploring the possibilities and the benefits, but now you're looking at from where our purview, our perspective is going to be, where's that money coming from? Is this a group of individuals, or is it strictly going to be institutional and large blocks? It's the only way to move forward, in my opinion. So these have to be long-term holders. They have to be professionals, and they have to be institutional for it to be something that I would even consider. And it has to be something that makes sense for the company's long-term goals. We're not in a position where we have to worry about short-term. What I'm concerned about is the continual growth of the company so that we're building a solvent, productive company that is constantly expanding, constantly growing, and improving across all metrics that I view as important. And I'm specifically stating that because I know many people watching this really see only one metric, price per share. That's it. What's the stock price? To me, that's short-sighted, but I understand it. For us, we follow a very simple recipe, and that is if the company does what it's supposed to do, continually innovates, produces product, introduces it to the market, the price per share will eventually follow. That's not something someone who's day trading wants to hear because they're looking at, I want this to go from 2 cents to $10, and I want that to happen in the next 30 days. Many of these expectations are very, they're not realistic, to be honest with you. I'm going to cut it off at that because I know some people will disagree with me on it. But we have to build a company, and that takes time. Okay, so let's jump into the S1 because everyone knows that's what we're doing. So the next step for us is to complete the audits. We're going to move into an S1. What is an S1? It's just a registration statement. We're registering shares that have already either been issued or that we are going to offer at an institutional level again. So let me just kind of put this caveat. Please don't call in and say, I want to buy stock. That's not what I'm interested in. We are going to be working with institutional investment banks, financiers, et cetera. And those relationships are already in place. So I don't need any phone calls on people wanting to buy stock. That's not going to be for the individual. I need to make sure that we have contractual relationships that are going to protect market liquidity and the value of the company. Okay, so what does this registration statement actually mean, aside from just registering shares? It is a way for us, which is what many IPOs do, to raise money, again, through institutional investment. What this is going to do is you're going to put through a Form ID application that puts you through the central index, the central index key, or what we call CIK, to file via Edgar. Edgar is an SEC data bank. It's an electronic data bank that allows us to upload all of our filings. These are for fully reporting companies. So I know it sounds complicated, but really all it is a mechanism for fully reporting companies to file their disclosures and statements and filings, whatever it is that they're looking to file, 10Ks, 8Ks, etc. And it's a centralized database where where institutions can go and pull down the information. Okay, so this covers a lot of the funding data material. I want to get into something that I've been asked quite a bit about lately, the 3A10. 3A10s are very interesting because very few people understand them, right? Everyone says they do. I was talking to investment bankers that have been in the industry 20 plus years. I've dealt with traders at a very high level within institutions, and everyone says they understand it. They don't. Unless you've had to go through it, unless you've had to deal with a legal team, an auditing team to go through it, and you've gone through the court system, they don't know what a 3A10 is. So 3A10, it's not for funding. I don't know where this came from. I received an email. Why don't we just raise money through a 3A10? Well, there's a very good reason. It's illegal. It's against regulation. So we don't file a 3A10 and have any money come back to the company. That's specifically not allowed, and with good reason, because people, when they first did it, they were taking advantage of it. It's unfortunate in many ways because it can help companies not only alleviate debt, but protect capital or their cash position. But the saying goes, just takes a few apples to ruin the bunch. That's what that is. So this is not a funding tool. 3A10 has its benefits and has its downsides. You'll notice that a lot of the 3A10s in the past, for those who actually follow this, a lot of them went through law firms that were probably a little unscrupulous, and they just kind of snuck them through. And then they created these entities or fake debt. And I'm not going to say any specific names, but it's something that's happened, unfortunately, more than it should have, right? So we don't do that. The 3A10s that we did, we filed through the court system, so they have to go through a higher level of scrutiny. All of the documentation has to be provided, but it also has to be viewable. There's no hiding anything, which is when we had a debt piece that we needed to settle, rather than that third party or those contracts having to wait or damaging the relationship, we proceeded to do some debt financing via the 3A10. Now, I want to be clear on what debt financing is. We did not initiate a debt so that we could do a 3A10 filing. That again is not what you're supposed to be using this tool for. There's a lot of tools you can use and misuse, and that is my specific issue with a lot of these tools. So a 3A10 does nothing more than settle debt. In many ways, it's set up almost, because I've gotten this question, it's, a lawsuit, if you will, but this is just a filing we go through that makes the equity available to a third party who's agreed to take on the equity and settle that debt to that other party, right, or that creditor, if you will. Why is that important? If you don't have the correct relationship where they understand this third party, that they understand the position of the company and what the plan is as far as long term, we don't disclose any information ahead of some non-public information. We don't disclose that ahead of any public statements or filings. But we need to understand that the people we're partnering with to settle this debt, they're not going to take a large block of stock and then damage the price per share and hurt shareholders by dumping this into the market, right? So they introduce all these new shares into the market and it hurts everybody. I had to learn this lesson the hard way, unfortunately, and now we have a relationship with a group that understands that we have to work together as a team and understand that this has to be something that can protect the shareholders' interests while also bolstering the company's not just the cash position, but also their disclosure status. So why am I kind of harping on this? It seems that there is someone or a few people going on one of these forums that people talk with, and they really misunderstood and missed the mark of what the 3A10 that we did 2 years ago. So this is something that if people want more information on, we can discuss. But I would recommend that due diligence is done on this and not go to the internet and say, what is a 3A10? Is it bad? Almost all of them are going to say it's bad. It's like any other tool. It can be used correctly or incorrectly. Anything can be abused. And that's why we did what we did the way we did it. So is there a way to utilize that in the future? Yes, there is, because we take that off the books this way. It ameliorates the position of the company on its financials, and it kind of gives us a little more opportunity to allocate capital to other resources, right? So that is, I got a couple of questions on this. So before this snowballed, because obviously this is being talked about, I want to address that. And that's one way we addressed the acquisitions that we've done. We had a debt, part of it needed to get paid, and you can break that up. We went ahead and addressed that, okay? So investors, when people ask what kind of investors we've approached or come into the company, accredited investors. You have to have a minimum understanding and experience level with investing. You have to be savvy to a certain level. And then also you have to have a minimum net worth, $1 million typically. So that is the accredited investors that we've approached in the past. Again, we're moving forward with an eye towards institutional investment. We're at the point now where we need to move forward with that type of posture and looking towards institutional partnerships. I think it's the best way. So obviously this next topic is going to be highly contentious. A lot of people they disagree with me on this. Most people misunderstand it completely. So reverse split. In the past 90 days, I'm going to estimate receive 50 emails requesting that I do a reverse split, rip the Band-Aid off. One of them said, this is, I don't know where this comes from. Now, and a lot of people say, they use this word, I hate reverse splits. I don't. I think it's a tool like any other tool. It can be used many different ways. The problem with this tool is it is widely misused to the detriment of almost everyone involved. So I appreciate people writing and calling in, asking me to do this. There's a reason I haven't done it. I'm not saying I wouldn't consider it under the appropriate circumstances. So let's talk about that. I think this is where some of the confusion comes from. Typically, and let's not specify where we've seen this, typically a reverse split that many of you would be familiar with is a company decides that they're going to do a reverse split. So they do a reverse split. They make no change to the cap structure other than that reverse split. And then they do a massive issuance and they dilute everyone. How did that benefit anyone? Other than the company now has a lower, it almost always tanks the stock price. They never get the capital in that they really feel that they're going to do by this issuance. They discount it. I've seen this more times than I care to enumerate here, but that's not beneficial. That's not a long-term solution. That is almost exactly a short-term, short-sighted solution. So let's talk about the correct way, because this is where the confusion comes from. What is it that Alex likes about a reverse split? Because he seems to hate them. Again, I don't. So a reverse split for me makes sense if you have to restructure the company and augment the cap structure in a way that has a strategy to move the company, propel the company forward. So if you were going to do a reverse split, protect the price per share, shrink with the market cap of the company as far as structure only, not dollars here, and you did no issuance, I would take a look at that's a viable option. That makes sense. Why do we need to do that? Why does changing the cap structure make sense? So for me, that is what the tool was meant for. It also stabilizes a market that might be too big, right? That's another way, one reason to do that. It will increase the price per share. Many companies do this to meet requirements, reporting requirements, and so forth on different exchanges. I understand that. How long is that going to last if you do a big issuance? How can you get shareholder support to do that if you execute this strategy and then just dilute them? I don't really view that as a partnership. And that's what I want to make sure we have with the shareholders. So yes, I would consider that. I understand where we are. I understand why those questions are being asked. I don't necessarily think doing something like that right now is prudent. Am I completely closed off to that in the future? No, I think that there's a strategy there, and there's an argument to be had to do something like that. I think that's further down the road to have that conversation. Could that happen tomorrow? I mean, I guess. I've had everything posed to me through some of these phone calls and emails. I just, right now, let's just focus on building the company. And then when it comes time to do something like that, we'll take a look at it. All of these arguments that have been given to me, please don't feel I don't hear them. I hear them, I take them in, I process that, and I make a decision. Some people don't like the decision I made about not doing that right away. Some shareholders I've been talking to for a couple of years, they've been calling for a couple of years. So I want to address that because I think the common feeling for this particular action, and there's also a forward split, right, where maybe the market's too tight. Maybe the cap structure is not where it needs to be for future funding. So you could do a forward split, lower the stock price, increase more shares, to be available, but also increase liquidity. So these are good things too. I mean, there's a benefit to all of this if you use these tools correctly. And there are many tools at the disposal of the C-level team that we can use, and we'll take those out on an as-needed basis. So no, I don't hate reverse splits. No, reverse split unto itself, I don't know where, I think I understand where it comes from, that this is just a bad thing entirely, because I sort of share that sentiment, but by itself, it's not bad. It's what people do after it that I have a problem with. It's what companies do after that corporate action that I take issue with. So understand that it is my responsibility to not just build a solvent company, but protect what we're building. So that's why we haven't done that to date. But again, I will always be open to suggestions, and we'll take a look at what's in the best interest of the company. And I understand why those questions are being asked right now at the current share price, with the current trajectory, as far as where we're headed and what the calendar is. So just give it a little more time. I feel that we're going to get to where we need to be without having to do certain things. Again, I don't think it's a detriment, but I will only use it if it's going to be a positive. Okay, so this just keeps coming up. So I went over the advantages in the correct way and the disadvantages in the wrong way. So hopefully this puts that to bed, because this is becoming an increasing communication through the shareholders in the company directly to me. Many people want me to do this right away. And just because I don't do something when you asked, understand that I sit, from the position or the vantage point that I sit in, I'm aware of things that you may not be. So some people, there's a few that take issue with the fact that I don't execute based off of their requests immediately. I have to think about all shareholders. I also think about the long-term solvency and viability of the company, but I also have to take into consideration things that we are already executing and things that we're going to be putting into motion. There's a lot of things that I may see that as a shareholder you don't. My goal is to get them out to you as quickly as possible, but in a very responsible way. Obviously, if I start releasing everything at once, it can be detrimental to the company, which again affects the shareholders. So a couple things I wanted to touch on. A couple phone calls I've been getting on manufacturing of certain products. I'm going to do a manufacturing video probably within the next couple days to a week. this is going to help us set up the capital markets, because the capital market series is not just about the capital markets, it's specific to our company, right? So you and I are shareholders in this company. We need to understand why it may take a certain amount of time. So we're going to have a manufacturing video. I'm going to cite some specific examples on things that we manufacture. And then we have to go through, we're going to walk through that process. I know many people are not familiar with the manufacturing process because they're not in manufacturing. So I think if we educate the shareholders and let them know why things might take a certain amount of time, then they'll understand. Oh, I get it. I understand why they were kind of dark for a couple of years. They were setting this up, and this is how long it takes. Could you imagine if I walked everyone through every step of the way over the past couple of years? It would have been something not many people have fully appreciated. I'll put it that way. It would have been very contentious, and it would have been something that, regardless, they're never going to look at it through the perspective of the person doing everything. So this is why we don't get into the specifics of what is happening each step of the way. I know some people want that, but that's a slippery slope, and it's just going to create a rabbit hole. We're never going to get to the end. We're going to be more distracted with, certain delays versus why don't we go this route, or what about this strategy? And this is something that has to be left to the team that's doing it. And then we report to you on where we are, in periodic steps. So this is going to be an important video, I think, for manufacturing. And then we're going to do a video on the strategy moving forward. We haven't really touched on that for a couple of months. So I kind of want to brief everyone, let everyone know that we've course corrected from last year, and we're still on the correct trajectory. So we're going to go over what that actually means. So there'll be another video coming out. I'm going to cut this one off because it's gone long enough, but I wanted to, I felt that this really needed to be addressed, and I'm going to try to give this to you in bite-sized pieces so people have time to actually sit down and watch a video. Nobody wants to sit down and watch an hour-long video or even a 30-minute video. I don't want to watch the 20-minute video of myself either. So I'm going to make sure we get this to you. Do apologize for the length. The next video on manufacturing will hopefully be a little shorter, but these are some of the things that I've been getting questions on, and rather than answer these individually, I thought there's probably a lot of people on these forums and chat rooms and boards and all of this that are getting the same thing, and they're just not contacting me. So let me address this for everyone, and we'll all get on the same page. And then the capital market series will come out probably within the next 2 weeks. I've got to finish up a couple of the videos, and then they'll be out the door too. There's a couple of things I want to touch base on, and then we're going to be doing the Q2 video on the financial statement or the disclosures, the filing. Something I want to walk everyone through and make sure that we all understand the same. We have the same takeaway. Okay, so thank you very much for sitting through this. If you're still with me, I know it's long, but I do feel it's important. I appreciate everyone's support, and if you have any questions that I've not answered, or that you're seeing a lot discussion on some of these other boards that I'm not aware of, please shoot me an email, let Candace and the team know, let them know what's going on, and then I'll make sure that I address it for the masses. Because if it's being put out there, we need to at least do our best, if it's prudent to do so, to address everything and get everybody squared away. All right, so thank you very much, and I look forward to talking to you in the next video. Thank you.